Welcome to this video presentation on the real estate industry in North America. This overview will provide some of the insights and culture that currently exists in the real estate brokerage business. The goal of this video presentation is to link the real estate culture to a real estate sales transaction. In North America, the first component of a real estate transaction is the property itself. This can be a single-family home, a condominium, condo, or an apartment. The property owner is referred to as the seller when the property owner decides to sell the property to another individual or family. When the property is put on the market for sale, the property is referred to as a listing. In most cases, the property owner will engage or hire a real estate sales associate, also referred to as an agent, to assist them with the marketing and eventual sale of the property. A listing agreement between the seller and the listing agent is authorized by the property owner, allowing the real estate agent to actively engage in selling the property. The real estate agent will present the property to individuals looking to purchase a property. Individuals looking to buy a home are referred to as buyers. They too will usually engage a real estate agent to find a property that meets their requirements. Real estate agents must work for a real estate brokerage firm. The real estate brokerage firm or company must be owned and operated by a broker owner. Broker owners are experienced real estate professionals who started as real estate agents, but with experience and additional educational requirements, can be authorized by a governing agency to start their own real estate brokerage business and hire real estate agents. In real estate terminology, a sale transaction between the seller and the buyer is divided into two parts. The seller and the property they are selling is called the listing or list side of the transaction. The buyer who is purchasing the property is called the selling or sell side of the transaction. It's a little confusing when the buyer is assigned to the selling side of the transaction. From the real estate agent's perspective, the role they played in the sale transaction was to sell the property. Therefore, it is considered to be the sell side of the transaction. All real estate sale transactions have a listing and a selling side. The seller agrees, within the listing agreement, to pay the brokerage firm a commission for the successful sale of their property. Real estate agents cannot be paid directly by the seller. The commission is paid to the broker owner, who in turn pays the agent a pre-agreed portion of the commission received by the seller. In a sale transaction, with a listing and selling side, the commission amount paid by the seller is often divided into two amounts. The list side will receive one portion of the commission amount and the sell side will receive the balance remaining. The amount of commission to be awarded to either the list or sell side is usually a percentage of the sale price. What the percentage amount will be for either the list or sell side will be agreed upon by the brokerage firm hired by the property owner. In most cases, the total gross commission will be split evenly between the list and sell side. 50-50 is very common in a real estate sale transaction. The broker owner and the real estate agents will have a prearranged agreement that determines what portion of list or sell side commission will be paid to the agent. A prearranged agreement between the broker owner and their agents is called a commission plan. Commission plans are a set of rules that will be applied to either a list or sell side commission amount. These rules will be used to calculate the portion split between the broker owner and the agents. Commission plans can be very simple or extremely complicated. Many broker owners will simply offer a single commission plan rate that stays constant and never changes. Other broker owners will have plans that provide a higher commission rate for the agent throughout the year, depending upon the agent's sales activity. Real estate is a highly competitive industry, and as such, broker owners are constantly looking for agent compensation strategies that will satisfy the agent's demands for higher commissions, and still provide enough revenue to earn a profit and stay in business. One strategy often employed by broker owners is to offer an agent a compensation plan that has a high percentage rate when calculating the agent's commission amount. At the same time, broker owners will subtract one or more fees from the agent's commission amount. These fees are referred to as deductions. In the world of real estate, there are two main deduction types. One is referred to as an off-the-top deduction, and the other is referred to as an off-the-bottom deduction. The broker-owner is constantly adjusting their agents' compensation plans to create the right balance of giving their agents what they want in higher commission rates, all the while ensuring the brokerage firm can stay profitable. It's important to note that in many cases, the broker-owner will have multiple compensation options, and each agent could be on a completely unique commission plan. Off-the-top deductions are applied prior to calculating the agent's commission. As such, the deduction is considered to be sales-centric. In other words, all agents on the side of the sale, either the list or sell side, will have an adjusted gross commission value as the base for the agent's commission. Off-the-bottom deductions are agent-centric, impacting only those agents that have a compensation plan that includes off-the-bottom deductions. This means that some agents will have no off-the-bottom deductions subtracted from their commission amount, and others could have one or more. In this spreadsheet example, we will demonstrate a simple sale transaction that has two agents on completely different commission plans, therefore their commission rate is different. The sale will also have a 6% off-the-top deduction for both the listing and selling side of the transaction. An off-the-bottom deduction for each agent will also be used, however, each agent will have a different off-the-bottom deduction rate. As mentioned earlier, broker owners will often have a number of commission compensation plans to match the experience and past sales activity of an agent. As this simple transaction illustrates, even though the agent's commission rate was 60% for the listing agent and 75% for the selling agent, when the off-the-top and off-the-bottom deductions are applied, the commission rate paid to the listing agent is 52% and 63% for the selling agent. Even though the agents thought they were being paid 60% and 75% respectively, their actual rate was lower after the deductions were taken into account. In many real estate sale transactions, one real estate brokerage firm could represent the seller, property owner, and another independent real estate firm could represent the buyer. Both real estate firms will have a prearranged agreement describing how each brokerage firm will be compensated in the sale. When another independent real estate brokerage company represents either the listing or selling side of a real estate transaction, they are referred to as an outside broker. In most cases, the information relating to the buyer or selling client or the commission arrangement between the outside broker owner and their agent is unavailable. Therefore, when an outside brokerage firm is involved with the sell side of a sale transaction, representing the buyer, the listing brokerage company, representing the property owner, seller, will have limited data about the buyer and absolutely no information about the outside brokerage's agent commission. So the sale transaction sheet, which is usually the original source of the sale transaction, will be incomplete. The missing data is just left blank. This is an example sale transaction where an outside broker firm sold the property, representing the buyer, that was listed by another independent brokerage, representing the seller. As illustrated in this form, other than the gross commission amount of $6,000, the remaining financial details are unknown. In real estate, most brokerage firms are associated with outside brokerage firms from different cities, states, or even countries. This network of brokerage firms will often provide potential buyers and/or sellers who are relocating to a different city or region to another broker within the referral network. When an outside broker sends a prospective client, either buyer or seller, the outside broker is referred to as a referral broker. Should a sale transaction be successfully completed with the prospective client, buyer or seller, the referral broker who sent the client will receive a portion of the commission for the side of the sale the client was involved in, either the listing or selling side. The amount of commission the referral broker will receive will vary from transaction to transaction. 25% is fairly common. This is another sale transaction with a referral broker involved with the listing side of the sale. In this example, the referring broker received 25% of the listing commission, or $1,500. Notice that the referral commission amount is subtracted, from the gross listing side commission amount prior to calculating the off-the-top deduction. So a referral broker commission amount is always calculated first and deducted from the gross commission prior to any other commission calculation. A single real estate sale transaction can have multiple brokerage firms and their agents involved. It's not uncommon for a single sale to have an outside broker on one side of the sale, list or sell side, and a referral broker, again on either listing or selling side, where both brokerage firms are sharing a portion of the gross commission amount. It's also not uncommon for more than one sales agent involved with the same side of a transaction, list or sell. Agents will often create teams where a single sale transaction will be divided among the participating agents. The splitting of the commission amount is prearranged among the agents themselves and usually varies from sale to sale. This transaction sheet illustrates two agents on the listing side of the sale transaction. In this example, the two agents have agreed to split the adjusted gross listing commission 60-40. Where agent number 1 receives 60% of the adjusted gross listing commission and agent number 2 receives the remaining 40%. This splitting of the adjusted gross listing commission is performed prior to calculating each agent's commission using their commission rate, based upon the agent's commission plan. The amount each agent receives at this stage of the commission calculation is referred to as a portion. The portion amount becomes the base value for calculating the sales agent's commission amount. In this example, agent number 1 commission rate is 60% and agent number 2 is at 75%. The selling agent is not affected by the portion splitting between the two listing agents. Notice that the off-the-top deduction is calculated and applied to the gross listing commission, creating an adjusted gross listing amount. The portion splitting between the two agents uses the adjusted gross listing amount. Also notice that the off-the-bottom deduction for each agent is calculated using the agent commission amount that was calculated after the adjusted gross listing amount was split between the two listing agents. It's not uncommon for multiple agents to be involved in a single sale transaction and on the same side of the sale, either the listing or selling side. Many agents will form a team where the team can consist of multiple agents, all sharing a portion of the commission amount. On these scenarios, the prearranged splitting can vary with each sale transaction. As you might imagine, with so many possible combinations of outside brokers, referral brokers, off-the-top deductions, agent teams splitting commissions, agent commission plans and off-the-bottom deductions, a real estate broker owner or their administrator can become confused when trying to figure out who gets paid what. This is where technology can assist the brokerage firm. With the right sales transaction management software, also referred to as back-office software, calculating even the most complex transaction can be easily entered and processed accurately. This presentation has provided some insights to the real estate brokerage industry in North America. The information presented, up to this point, creates the basis for learning about how to enter, process, manage and calculate a sales transaction using a back-office software solution referred to as SMARTS. Let's take a quick review of what we have presented so far. A sales transaction starts with a property. When the property owner wishes to sell their home, the property owner is referred to as the seller. The seller will engage a real estate agent, who will market and eventually sell the property to a buyer. The property owner, seller, will sign an agreement with the real estate agent, outlining the conditions for the sale of the home. This contract between the seller and the agent is referred to as a listing agreement. Once a listing agreement has been authorized by the seller, the property will become known as a listing. The listing will be placed into the marketplace using a central multiple listing board, referred to as a MLS board. Included in the terms of the listing agreement is the commission amount that the seller agrees to pay the agent. This is usually represented as a percentage of the final sale price that a willing buyer paid to the seller. The commission paid to the real estate agent's brokerage firm is referred to as the gross commission amount. Real estate agents work within a brokerage firm. An agent can never receive a commission directly from the seller. The seller will pay the broker owner, and the broker owner will in turn pay the agent. Broker owners and their agents will have a prearranged commission agreement, referred to as a commission plan. The commission plan has a series of rules that will be used to calculate the agent's commission on a sale. The gross commission amount is generally calculated as a percentage of the final sale price. 5 to 6% is fairly normal, but any percentage can be negotiated between the seller and the listing agent. The gross commission amount is divided into two portions. One portion pays the brokerage firm who listed the property, and one portion will pay the brokerage firm who sold the property. It is not unusual to see two independent brokerage firms list and sell the listing. In this scenario, the listing broker will pay a prearranged commission amount to the selling brokerage firm. In many cases, the listing brokerage firm and their agents can list and sell the listing without an outside brokerage firm. The gross commission amount is still divided into two parts, one for the list side and one for the sale side. Outside brokerage firms can participate in a sale transaction by either listing or selling the property, independent of the role another brokerage firm played in the sale of the listing. Outside brokerage firms can also be a referral broker. A referral broker is usually from another region and refers a prospective buyer or seller to another brokerage firm in a distant region the prospective client wishes to live. Referral brokerage firms receive a referral commission. The amount of the commission will be prearranged and will only impact the side of the sale the prospective client participated in. The listing or selling side. The referral commission amount is always the first calculation after the gross commission amounts have been calculated for the listing and selling side of the sale transaction. Off-the-top deductions are applied to the adjusted gross listing or selling side commission. If a referral broker was involved in the sale, the off-the-top deduction will be calculated after the referral commission has been subtracted from the gross commission amount. An off-the-top deduction is considered to be sales-centric. This means the broker owner and all agents on a specific side of the sale, list or sell, will have their commission amount reduced by the off-the-top amount. When a sales transaction has been listed and sold by the same brokerage firm, often referred to as an in-house sale, and there is an off-the-top deduction to be applied to the commission calculation, the off-the-top deduction will be applied to both sides of the sale. When an outside brokerage firm is involved with the sale, either the list or sell side, no off-the-top deduction is applied. Independent brokerage firms will have no idea as to what the other outside broker is doing when it comes to commission calculations on their portion of the commission. Agents will have a prearranged commission agreement with their brokerage firm. This agreement will define the calculation method the broker owner will apply when determining what the agent's commission amount will be when the listing is sold. It is possible that a broker owner will have more than one commission plan, and their brokerage firm could have each agent on a completely different commission plan. Broker owners will often employ a compensation strategy that gives their agents a higher commission percentage rate on the commission plan, but also use off-the-bottom deductions to reduce the agent's final commission amount. Commission plans can be a single commission rate for every sale transaction the agent is involved in, or they can be complex with multiple variables or calculation rules that rewards the agent with higher commission rates based upon the agent's sales activity. This concludes the high-level overview of a real estate transaction and its components. To learn more about the real estate industry in North America, please perform your own research and review. Now let's use the basic information presented within this video and related to entering a sales transaction into Smarts, a back-office solution specifically developed for processing real estate transactions. This video is not intended to instruct you on the use of the Smarts back-office application. There are a number of training aids available, including video, to assist you in learning how to use the Smarts product. The remaining section of this video will relate the sales transaction and all of its data components with the data entry screens within Smarts. Prior to entering a new sales transaction into the Smarts back-office application, a few setup steps are required. This is the company setup entry screen. Once a company has been set up, it rarely requires any adjustment. Landtrax will be responsible for the creation of the new broker owner within Smarts and completing the company details. A real estate brokerage firm can have more than one sales office, referred to as a branch office. This simple branch office setup screen allows the branch offices to be identified within Smarts and allows some default values to be set. The default settings will be used when entering new sales. Default settings can always be adjusted within any sale transaction. Smarts allows up to 3 branch offices. As mentioned earlier in this video presentation, agents will have a pre-arranged commission agreement with their broker owner. This screen defines the rules to be used when calculating the agent's commission amount within a sale transaction. This setup is referred to as a commission plan. The creation of commission plans is the responsibility of the broker owner and not the agent. Data entry personnel never create commission plans. When a broker owner creates a new commission plan, the data entry personnel will simply enter it into Smarts using this screen. This commission plan is fairly simple with just 2 levels. Commission plans could have a single level where one commission rate is used on every sale transaction regardless of the agent's sales activity. Multiple level plans become more complex, where the agent's year-to-date sales performance will determine the commission rate to be applied. In this example, the commission plan starts with a commission rate of 60%. Once the agent has closed a number of sale transactions and generated $25,448 of gross commission income, the agent will be promoted to the next level on the plan. In this case, 91%. This commission plan has 4 levels where the agent starts with a 50% commission rate, and as they produce and close more sales, their commission rate can elevate to 60%, then 70%, and finally 90%. The agent would have to produce $40,000 of net company income to have the 90% commission rate applied to any future sales transaction they were involved in. One final setup step to complete prior to entering listings or sale transactions into Smarts is to enter the agents. This screen is where each agent will be entered. This is where the agent's commission plan is assigned. Once entered, adjustments to the agent's information are rare. Before a sales transaction can begin, a listing is required. If you will recall, the listing is the property the owner wishes to sell. A listing will have a property owner referred to as a seller. The seller will engage a real estate agent to list the property and eventually sell the home to a buyer. The listing agent will work from a branch office. All agents must work at a brokerage firm. This is the listing data entry screen within Smarts. As illustrated, the listing information required within Smarts is limited to about 10 items. The seller information will be entered into the client component within Smarts. The listing agent will be entered prior to entering listings or sale transactions. In most cases, the listing details can be entered in less than 1 minute. A property that has been listed will have a lot of information about the property, such as number of bedrooms, bathrooms, square footage, and the many features that the property has to offer. However, for Smarts and the purposes of entering a sale transaction when a listing is sold, only the most basic information is required. The basic listing information will be supplied by the office administrator working at the brokerage firm. A simple form will be used to fill in the details and then digitally sent to the data entry personnel. Broker owners and their agents are encouraged to submit the limited listing details immediately upon securing the listing agreement. The time to actually sell the listing varies from days to months. Having the listing information entered and managed inside the SMARTS application allows the broker owner to use data analytics to review listing activity within their real estate firm. This is the data entry screen for clients. Clients are the buyers and sellers on a sale transaction. As illustrated in this screen, the number of items required for the client is quite limited. Clients will rarely be pre-entered into SMARTS prior to entering a listing or a sale transaction. Therefore, SMARTS has an on-the-fly feature that allows the data entry personnel to add new clients to a listing or sale without leaving the listing or sale transaction data entry screen. When an outside broker is involved with either the listing or selling side of the transaction, the client information will be unknown to the other independent broker and their agent. In this case, the client information is extremely limited, with only the client's name being available. The remaining information is often left blank. Client information entered into SMARTS will be saved for future use, should they be involved in another sale or listing. For the purposes of data analytics, brokers and their agents are encouraged to provide as much information about their clients as possible. Client information could also be used in post-sale activities, such as surveys, referral requests, etc. The information about each buyer or seller client will come from the broker owner's administrator. The agent is usually responsible for providing client details to the administrator. A simple digital form can be used to complete the client data and sent to the data entry personnel for entry into SMARTS. Outside brokers are also referred to as third-party vendors or companies. Broker owners and their administrators are encouraged to pre-enter, also known as onboarding, all of the outside brokerage firms they have dealt with in previous sale transactions. Having the outside brokers pre-entered and saved within the SMARTS application makes it much easier to enter a sale transaction when an outside broker or referral broker is involved in a sale. Most listings are marketed through a central data processing organization, often called a multiple listing service or MLS board. With the listing exposed to all brokerage firms associated with the MLS board, it is very likely that a sale transaction will have two separate brokerage firms involved in the sale transaction. One firm will represent the seller via the listing agreement and the other will represent the buyer. Therefore, many real estate sale transactions will require the outside broker information to be included in the sale record. Outside broker firms can be used multiple times in multiple transactions. Once entered into SMARTS, adding the outside broker to a sale is quick and easy. In the event a new outside broker is required for a sale transaction, SMARTS has an on-the-fly feature that allows the data entry personnel to enter and save the new outside broker without leaving the sale data entry screen. This is the third-party data entry screen where outside brokers can be entered and saved for future use. The amount of data required is also limited to just the basic information. Entering a new outside broker into SMARTS should take less than a minute. Once the outside broker has been entered and saved, it only takes a few seconds to locate the outside broker information, select the appropriate outside broker record, and instantly link it to the sale transaction. It will be the responsibility of the broker owner's administrator to provide the data entry personnel with the outside broker information. A simple form can be used by the broker's administrator to complete the required information and digitally send it to the data entry personnel. This simple graphic illustrates the various data components contained within a sales transaction. The listing, which is linked to the seller, is also linked to a listing agent and their brokerage firm. The listing is attached to the sale transaction record and in doing so, links the broker, branch office, agent and agent's commission plan data, all which are required to process the sale transaction. On the buyer side, the components include the selling broker, the branch office, and the selling agent. It is possible that the selling broker is the same as the listing broker, or it can be an outside broker office and their agent. The seller is also linked to the sale transaction record. If the selling broker is an outside broker, then the agent's commission plan will be unknown. It's also likely that the buyer's information will be limited or also unknown. Let's review the order of calculations within a sale transaction. This simple spreadsheet will provide a visual representation. The first value required is the sale price. This is the amount the buyer paid to the seller. With the sale price entered, the next calculation is the total gross commission amount. This amount is generally a percentage of the sale price. In this example, we will use a 6% rate to calculate the gross commission amount. 6% of $200,000 is $12,000. With the gross commission amount calculated, the next step is to split the gross commission into two parts. One for the listing side and one for the selling side. In our example, the gross commission amount was evenly split 50-50, providing each side of the sale transaction $6,000. An outside referral broker was involved in the sale. When processing a sale transaction with a referral broker, the referral commission is always calculated before any off-the-top deductions. In our example, the referral broker commission amount was 25% or $1,500 on the listing side of the sale. The referral commission is subtracted from the listing side gross commission amount, creating an adjusted gross listing amount of $4,500. The adjusted gross listing amount of $4,500 will be used to calculate the list side off-the-top amount. Off-the-top deductions affect the commission amounts for the broker owner and all agents assigned to either the list or sell side. In our example, 6% was the percentage rate used to calculate the list side off-the-top value. The same 6% was also used on the sell side. Notice the adjusted gross listing side is less than the adjusted gross selling side. The reason for the difference is because of the referral commission being calculated and subtracted from the gross listing side commission prior to calculating the off-the-top deduction. The next step is to calculate the agent's commission amounts. It is not unusual for each agent on a sale to have a different commission rate. The actual commission percentage rate will be determined by the agent's commission plan assigned to them. In our example, the listing agent was at 60% and the selling agent was at 75%. The agent's commission rate will be applied to the adjusted gross commission amount for both the list and sell side of the sale transaction. The final calculation to perform is the agent's off-the-bottom deduction. The off-the-bottom calculation uses the agent's commission amounts as the base amount. In our example, the listing agent had an off-the-bottom rate of 8% and the selling agent was at 10%. With all of the calculations now performed and in their proper order, the adjusted agent commission values will be known. The total commission amounts paid to the agents is subtracted from the adjusted gross commission amounts, resulting in the broker owner earning $3,728 on this transaction. When entering a sale transaction into the SmartS application, all of the calculations are automatically performed. The data entry personnel never have to manually figure out a commission value. Notice that the listing agent's final commission rate is 55%, which is lower than the 60% used in the agent's commission rate. The selling agent's commission rate is also lower at 68% and not the 75% entered above. The difference is the off-the-bottom deduction applied on the sale transaction. As mentioned earlier, broker owners will often use off-the-bottom deductions to increase the company revenue and provide an illusion that the agents are receiving a higher commission rate. The next section of this video will demonstrate the data entry of a sales transaction within the SmartS application. This is not a step-by-step instructional presentation on how to use the SmartS application. There are a number of training aids, including videos, developed specifically to instruct a data entry person on the use of SmartS. The purpose of this final section of this video is to illustrate how the various components of a sale transaction, described throughout this presentation, relate to the data entry process. The following demonstration of the SmartS application will contain very little audio description. Again, for detailed instructions on the use of SmartS, please review the various training videos available. Let's get right to the demonstration and illustrate just how easy it is to enter a sale transaction. The information for a sale transaction will be provided by the broker owner or their administrator. In most cases, the information will be completed on a sale transaction sheet, often referred to as a deal sheet. Not all of the information on a deal sheet is required to process the sale through Smarts. The deal sheet will be digitally sent to the data entry personnel for them to enter the sale into Smarts. This is the main menu screen that will be displayed when you start the Smarts application. This demonstration uses the on-the-fly method to add a new listing, a new seller and a new buyer, and link them all to a new sale transaction. Clicking the Sale button will display the sale data entry screen. From this screen, all of the components that make up a sale transaction will be entered, saved, and ready for a specific date where the buyer and seller will complete the transaction. This is referred to as closing the deal. The property record or listing does not exist in Smarts, so it will be added on the fly. The property owner or seller is also new and will need to be entered into Smarts using the on-the-fly feature. With the new listing and seller entered, a select option will link the listing and seller information to the new sale being entered. Upon selecting the new listing, Smarts will redisplay the sale data entry screen so that we can continue to enter the remaining information on this sale transaction. The buyer is also a new client and will not be pre-entered into Smarts. Using the on-the-fly feature, the new client is entered, selected, and linked to the sale transaction. The next step is to provide the financial details about the sale, including sale price, gross commission amounts, referral brokers, off-the-top deductions, agents involved in the sale, and any off-the-bottom deductions. Agents will usually be pre-entered prior to implementing Smarts, so it is rare to enter a new agent on the fly. Each agent will have this commission detail screen to enter the financial details on the sale. If the agent has any off-the-bottom deductions, this is where they will be entered and calculated. The agent commission rate will be automatically inserted into this agent commission detail screen. The rate will be determined by the agent's commission plan. Data entry personnel do not need to calculate any commission amount as SMARTS is fully automated. With the financial details entered and the agent's commission calculated, the last step is to complete a few more detailed about the sale. A new sale transaction is referred to as a pending sale, and its status within SMART will be tagged as pending. When a prearranged date arrives, the sale will be closed. Closing a sale requires minimum effort and can usually be performed in seconds. The time to enter the sale transaction was approximately 5 minutes. If the listing, seller, buyer, or outside broker details were pre-entered, then the amount of time to enter the sale would be significantly less.
Thank you for watching this real estate industry overview and how it relates to processing a real estate sale transaction. Please review another video on commission plans located on YouTube.